Toronto and London AIM-listed West Africa gold producer Avesoro Resources has just updated investors for the first half of the year. It produces gold at the New Liberty gold mine in Liberia and the Yuga mine in Burkina Faso. With first half gold production of 128,300 plus ounces, it's confirmed it's on target for full year production of between 220 and 240,000 ounces of gold. In the most recent quarter, it reported an all-in sustaining cash cost of $985 per ounce of gold. Geoff Eyre is the CFO. He joins us now with some more. Just explain a bit more of what's been going on, because I talked to her about the first half. I think a bit of explanation needs to be given to us about the difference between the second quarter and the first quarter of that first half.
Well, the company has grown very, very quickly over the last couple of years, actually. We acquired the Burkina assets in December of last year, so they've made a significant contribution to the gold production performance of the business this year. They've also had an effect of reducing the overall cash cost and AISC for the business. So as you mentioned, we produced 128,000 ounces of gold in the first half of the year, which is well on track to achieve the guidance of 220 to 240,000 ounces. The cost curve for the business has come down significantly over the last couple of years. In addition to the Yuga asset, which came into the portfolio in December, we also acquired the New Liberty mine from Austrian, which was acquired around 18 months ago now. That asset was struggling, presented a good opportunity to us, so we took a controlling stake in that asset for $30 million, and since then we've been focused for the last sort of 12-18 months or so on turning that around, and we've been successful in turning around that asset from something that was losing $88 million a year to a mine which in the first quarter of this year generated $15 million of cash, and has continued to sort of improve its production into the second quarter of this year.
Yeah, you mentioned the two mines there, New Liberty, which of course formerly belonged to Austrian, and I think Endeavour, didn't they, had the Yuga mine in Burkina Faso. I mentioned the difference between the first and second quarters purely because the second quarter production was down a touch. I want to get on to the cost in just a minute, but production itself was down a touch at Yuga in the second quarter over the first quarter. What's happening there, and is that something that should concern investors for the remainder of the year?
It shouldn't concern investors. The reduction in production from Yuga was as planned. The first quarter for Yuga specifically was a tremendous, exceptional performance in the first quarter. That was driven by very high grades that were available to us to process in the first quarter of the year following the acquisition of the mine. Yuga in the second quarter of this year produced just over 30,000 ounces, which is what we would expect in line with its contribution towards the overall guidance figure of 220 to 240,000 ounces. So Yuga this quarter has performed as we planned, and we expect it to continue plus or minus in Q3 and Q4 of this year at the same sort of level as you've seen in Q2.
From your seat as CFO, how important is it for you to get these costs down? I mean, if you split them down between the two mines, I think Yuga is $852 all-in sustaining costs, $852 an ounce, but the New Liberty mine is $1,038. Now that is getting perilously close, if you add in other costs, to the price of an ounce of gold.
Yeah, the blended cost for the two mines together was $958 per ounce AISC. If you look at Yuga specifically to start with, the costs there are relatively low. The mining cost for the second quarter was less than $2 a tonne, which is an exceptional performance, and we also reduced the processing cost down to less than $20 a tonne. So we'll see small incremental improvements in the cost performance at Yuga, but it's delivering in line with expectations and is very profitable in its own right. Turning to New Liberty is an asset that, as I mentioned, we acquired that was in a very, very difficult circumstances at the time that we acquired it. We've turned that around over the course of the last 12 to 18 months. It's now a profitable mine. It's now delivering strong cash flow. However, within the AISC number for New Liberty specifically, there's around $150 per ounce in there that relates to catching up on waste stripping. So with the difficulties of the asset before we acquired it, there'd been a focus on ore production and not keeping up with the waste stripping ratio. So it's a necessity to sort of catch up with that ratio. So a portion of the cost that we incur is effectively capitalized stripping, and that contributes $150 per ounce to that AISC number, but that will drop away in subsequent years. In fact, if you look at the 43101, which is a competent persons report for the asset, the anticipated AISC over life of mine is $750 an ounce. So that the cost performance will improve.
That's at New Liberty?
That's correct, yeah.
Right, so it's a substantial drop then on what you've got at the moment. As you said, hopefully that's going to come down. I want to talk as well about cash on the balance sheet. You're a cash-generating company, obviously, with profitable mines. You've got, I think, what is it, 12.7 million came onto the balance sheet. Is it in the first half, was it?
The closing balance at the end of June is 12.7 million, that's correct. We actually generated 48 million of cash in the first half of the year.
Right, okay, and your debt standing at 134.5 million. Is it a priority to get the debt down? Or what are you doing with the money that's coming onto the balance sheet?
Well, to deal with each of those questions, in terms of the debt, it's a reasonable cost of debt at the moment. It's a sustainable number for the business, though that's not the priority for the cash generated from the business. Because of the history of the assets, New Liberty specifically, when that went into the mine development around 4 years ago, 5 years ago now probably, when the mine development started, the focus on exploration completely stopped. Now, when people invested in that, when the decision was made to build the asset, everybody was very enthusiastic about the additional exploration ground that came with the asset and the opportunity to increase resources well beyond what was necessary to take the mine build decision. We're now going back to that, and we're investing significant amounts of capital into the exploration program for New Liberty to increase resources, increase the mine life, which we think will have an immediate impact, positive impact on the valuation of the asset. So in the first half of this year, we've redirected around $10 million of cash generated from operations into exploration, both at New Liberty and Burkina, because we see that will deliver additional ounces, add mine life, and increase the value of the assets. We've already, from the work that we've done this year, increased the reserves at Yuga by 29%. So that's had an effect of adding 2 years to the mine life of those assets. We're confident with the work that we're doing at New Liberty that we'll also be extending the mine lives. It's just a function of the history of the assets and the fact that there wasn't that focus on exploration. Now that both of the assets are performing very well and are operating well and generating significant cash flow, it's appropriate for us to redeploy some of that cash into exploration, because we think that's where we can generate significant value for shareholders.
Yeah. Where do you go from here? What is your priority now? You talk a little bit more about the expansion of the mine and so forth. I want to talk about this in the context of the share price, if we can, and ask you what is built into the share price. You mentioned a couple of things going forward, such as the expected drop in the all-sustaining costs for the New Liberty mine. And of course, we've also got to consider the backdrop to this is gold now at levels not seen in many, many months, at around 1,200 an ounce. So 238 pence. This is the, beg your pardon, this is the London listed stock, isn't it, at the moment?
That's right.
You're on Toronto as well. Yes. You've got a market cap of 260 million. What do you think is, or what do you place in terms of value in the company on what you just said? Is there anything about the future of the cost base included in this? Anything about the expanded production in this? What are we looking at?
I think we saw a significant improvement in the share price earlier in the year. If you look to around sort of, I think it was April, May time, the share price was up about 50% on the start of the year. I think that was a reflection of the strong operating performance coming through in Q1. I think that's sort of been sustained through Q2, with Yuga stabilising at its sort of operating level, and we think we'll see a continued tick up in operating performance at New Liberty. The share price has come off a little, which we think is a function of obviously the gold price, which, as you mentioned, is down at around sort of 1,200 or so now. So I think, but where we see the value driver, where we don't see it sort of reflected in the share price at the moment, is this potential to add significant ounces in terms of the reserves conversion from the exploration programs that we're doing. We're drilling 171,000 metres of diamond drilling this year, which is an exceptionally significant number. As I mentioned, we've already had a 29% increase in reserves at Yuga. We're expecting to be able to announce in Q3 an increase in the reserves at New Liberty, and those numbers should drop through directly into the bottom line on the sort of long-term forecast of cash generation for the assets. So we don't see that priced into the share price at the moment, and that expectation, notwithstanding the significant amount of drilling that we are doing, and the fact that we've had a lot of success so far.
By the end of the year, where do you hope to be? Obviously, clearly on your way to between 220 and 240 ounces of gold.
Yes, well, we're very confident we're maintaining the guidance. Today we put out the half-year numbers, so we've reiterated that guidance for the year. So we're confident about that. We're looking towards next year, and the sort of annualized production target is to sort of maintain at similar levels to what we're achieving for this year. We'll be starting to look at underground options for New Liberty, where there's the significant underground potential. The mineralisation, the grade actually increases, and the widths are wider as you go deeper with that deposit. So there's, on the face of it, significant underground potential which needs to be explored. We're also drilling De Blama, which is a satellite target 40 kilometres from the New Liberty mine. We've done a significant amount of drilling so far this year, and the results are very encouraging. So we're looking forward to sort of putting that into reserves and resources statement and pushing out the mine life. So, you know, I think production, we're confident with the production. Looking forward to next year, our objective would be to maintain it at similar sort of levels, but the real value driver is going to be from these increases in reserves and extending out the mine life, which is why we're very focused on the exploration activities. And as I said, so far we've had a lot of success.
Okay, look, Geoff, we've got to leave it there, but thanks indeed for joining us. Geoff Eyre is the CFO of Avesoro Resources. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.